Back in the 1970s, our predecessor body, the IASC, developed the first set of international accounting standards known as IAS. Many jurisdictions base their national standards on IAS, but modified them to reflect local preferences. Problem was different jurisdictions made different modifications to different standards. And like a Hollywood movie that says that it is based on a true story, national accounting standards often bore only a vague resemblance to the international accounting standards on which they were based. Now, thankfully, this model of jurisdictions modifying international standards is largely a thing of the past. And it is replaced by most of the world using a single set of high-quality, globally accepted standards, IFRS standards. Of the 166 jurisdictions that we have surveyed in the last few years, no fewer than 144 have fully adopted IFRS standards. IFRS is now required for use by 95% of the surveyed African jurisdictions, 90% of Europe, and by 100% of the Middle East. Almost all of the Americas, with one notable exception, and many Asian countries are fully on board. And there are many fathers to this success, but it is important to mention IOSCO, the World Federation of Securities Regulators, the European Union, who was the first to take this brave step, and Australia, New Zealand, Hong Kong, and South Africa, who were all first-time adopters. Now, there are still a couple of wide gaps on the IFRS map of the world, as you can see. And the biggest gap is the country of US GAAP. While foreign issuers are able to use IFRS on the American capital markets, American companies themselves are still not able to do so. I think that is unfair discrimination, by the way. In 2011, even before the Trump era, it became clear that the United States would not be adopting IFRS standards anytime soon. Fortunately, the rest of the world reacted then just as it does now in the face of the American challenge to the global trade system. Rather than following the United States in retreat, the use of IFRS standards continued to spread around the world. And indeed, we continue to see encouraging developments among key jurisdictions that are still on the road to adoption. China, for example. China is using national standards that are very, very close to full IFRS. And China is still committed to achieving full convergence over time. China has adopted without any modification all of the new major standards, IFRS 9, IFRS 15, IFRS 16, and it is in the process of adopting IFRS 17. As you can see on this slide, more than 300 mainland Chinese companies already produce IFRS financial statements for the purpose of their dual listings in Hong Kong. Their financial reports and they also report at home in Chinese GAAP. And what is very interesting to see that when you compare the two GAAPs, that more than 200 companies show no difference at all between Chinese GAAP and IFRS. And of the remaining companies, as you can see here, the differences in outcomes are minimal, as the slide shows. And given these results, achieving China's stated claim of full convergence with IFRS standards only requires a very small step, and I'm sure that this step will be taken. Then Japan, that is a very interesting case as well. It's a sort of a petri dish of accounting standards. Japanese companies can choose between 4 different sets of accounting standards: Japanese GAAP, US GAAP, full IFRS, and Japanese modified international standards, so-called JMIS. And the JMIS is a modified version of IFRS with 2 carve-ins relating to goodwill, there is amortization, and recycling of equity investments. But interestingly, no Japanese company is forced to use a particular standard. It is really a case of let the market decide. So it's interesting to know what has the market decided in Japan. As of today, as you can see here, around 200 mostly big multinational Japanese companies have chosen to adopt full IFRS, representing more than 30% of the total market capitalization of the Tokyo Stock Exchange. And in addition, some very big Japanese companies are seriously looking at adoption of IFRS standards, and before long, 50% of the Tokyo market cap is expected to be on IFRS. And the number of Japanese companies that is still using US GAAP has been steadily shrinking, and it's expected to be less than 10 companies soon. But perhaps most interestingly is that not a single Japanese company has chosen to adopt the modified IFRS standards. Even those companies who have strongly argued for modified IFRS standards in the end decided to adopt IFRS pure rather than modified. And why is that the case? Well, according to a report by the Japanese Financial Services Agency, the top 3 benefits of IFRS for Japanese companies are, first, that the efficiency of being able to use the same standards in all subsidiaries around the world. Secondly, enhanced comparability and better communications with international investors. And the Japanese IFRS adopters, that they know that even limited modifications to IFRS will undo much of these advantages. India, also interesting, has recently adopted accounting standards that are based on IFRS standards. And those new standards in the US are a great step forward, but they do contain quite a few modifications of IFRS requirements. India knows that these modifications mean that it cannot derive the full benefits of IFRS, and it therefore wants to remove them over time. A few might actually disappear through changes in IFRS standards themselves, but most will require action by India itself. And that will not be so easy because modifications can be as hard to change as accounting standards themselves. But as the Japanese experience suggests, the cost of maintaining modifications is probably higher than removing them in the end. So overlooking this picture, it is clear it is not perfect, but the progress that we have achieved in the last 15 years is truly nothing short of astounding. And this progress is all the more remarkable given the fact that the IFRS Foundation is not an international treaty organization. We are a private body, and our standards are not binding on anybody. We cannot impose anything, and the adoption of IFRS is nothing but the free choice of sovereign jurisdictions. So, given the voluntary nature of IFRS adoption, we like to believe, of course, that the adherence to our standards is a reflection of the quality of our work and the fact that we do it in a very inclusive way. But I think there is more to it. Most of our constituents resist the temptation of modifying our standards as a consequence of what we in Dutch call welbegrepen eigenbelang. I see a wave of recognition Well, what does this mean? In English, this means literally, welbegrepen eigenbelang means literally well understood self-interest. But it could also be translated as enlightened self-interest. Acting in enlightened self-interest means foregoing a smaller self-interest to achieve a bigger self-interest. And even when our constituents may not agree with certain aspects of our standards, they know it's not in their enlightened self-interest to modify them. They know that this could set in motion a process of gradual balkanization of the world of IFRS, undoing the benefits of a single set of global standards. As many of you will know, the European Commission is currently conducting a fitness check on public reporting by companies. And this fitness check covers a wide array of reporting issues, but it also contains the question whether the European should have the ability to modify IFRS standards. And clearly this is a sovereign decision for the European Union itself to make. And the fact that this is the third time in 5 years that the European Union asks itself this question means that we cannot take European adherence to unmodified IFRS for granted. Fortunately, the outcome of the 2 previous consultations was that Europe should forego making modifications to IFRS standards. And of course, we hope that this third time around, Europe will again conclude that it is not in its enlightened self-interest to go in this direction. Especially in a time when global standards are under such tremendous pressure, this would be a very welcome outcome. And the questionnaire of the fitness check is open until the 21st of July of this year, and we hope that many of you will find an interest in participating. It's an easy thing to do. So, let me now turn to the standards themselves. What is occupying the thinking of the board right now? I will leave it up to my colleagues to cover the detail in the next 2 days, but I do want to talk briefly about a couple of areas that the board is focused on. First of all, we have the primary financial statements project, the PFS project. A very important project for us, and I suspect also for many in the room. So it is important that we get this right. The objective of the PFS project is to provide better formatting and structure in IFRS financial statements, especially in the income statement. Currently, the IFRS income statement is relatively form-free. We define revenue and we define profit or loss at the bottom, but in between we do not define all that much. While in practice, both preparers and investors like to use subtotals to better explain and understand performance. We may end up introducing around 4 or 5 additional subtotals, including subtotals which come close to what people consider operating profit and earnings before interest and tax, EBIT, which is both subtotals are widely used in the market. We are also thinking about defining some new line items, especially regarding financing and investing activities. And this is all very important work because, as I said, nearly everybody reports operating profit and EBIT, but they don't do so in the same way. There is simply no comparability. Standard definitions of these terms will provide investors with greater comparability among income statements. And they will also help creating more discipline around non-GAAP measures by providing more anchors in the financial statements to which they can be reconciled. Also very important to the regulatory community. And we may also require preparers that when they use non-GAAP measures to introduce them in the notes so that they become subject to audit, and where they should then also be reconciled to the nearest subtotal in the financial statements. The PFS project will also help as more and more of this financial information is produced and consumed digitally. You have no idea how much investment is now going on in an automated fashion based on algorithms. And the greater the amount of data consumed by investors, the more important it is that the data are properly structured, consistently defined, and tagged. And to understand the importance of this, look no further than what I would call the Hathaway effect. Back in 2012, US researcher Dan Mervish noticed a very strange correlation between the news stories mentioning Hathaway and a spike in the stock price of Warren Buffett's Berkshire Hathaway. And not entirely surprising until you realize that many news stories related not to Berkshire Hathaway, but to the Hollywood actress Anne Hathaway, who you see here on the picture. And the same thing happened each time when an Anne Hathaway film came out, 6 occasions in 2 years, and that was simply too much to be a coincidence. So poorly configured algorithmic trading systems were rumored to be at fault, buying Berkshire Hathaway stock whenever Anne Hathaway was mentioned in the news. And it's just a fantastic story, and apparently it's really true. It highlights the problems with using unstructured data sources with algorithmic trading, especially when the trades are made by a computer that cannot tell the difference, but not as yet, between Anne Hathaway and Warren Buffett. Should be quite easy to resolve. So now you better understand also the success of Warren Buffett. And let me move to his favorite investment, which is the insurance industry. We issued IFRS 17, the new insurance standard, 1 year ago, and it comes into effect in 2021. And the standard has already been endorsed in Australia, in Canada, in Hong Kong, Malaysia, New Zealand, Singapore, South Africa, and Switzerland. And it is also very close to endorsement in China and in South Korea. And who knows when North Korea may follow. President Trump has promised to put in a good word for us. IFRS 17 will bring huge benefits in terms of standardization and quality of information. By creating better insight in the risks and performance of insurance activities, the standard will also contribute to financial stability. We are also confident it will benefit insurance companies themselves by providing better management information and by enabling more investors to understand insurance companies. Many general investors now stay away from the insurance industry because they find it too difficult to understand. I'm sure that the standard will increase the investability of the industry. At the same time, we recognize that the significant implementation challenges faced by insurance companies, that there are very significant implementation challenges faced by the insurance industry when they are transitioning to the new standard. And that is why we are devoting considerable resources to support implementation. And those include webinars, educational materials, helping to prepare the market by running investor education sessions, and through the work of the IFRS 17 Transition Resource Group, or TRG. The TRG is a public forum for discussion among preparers, auditors, and regulators. It is a great concept, having everybody around the table and working through the practical challenges of implementing the new standard. And it's also a great way to help educate others implementing the standard. The discussions are also useful for us at the ISB itself to see if any action is necessary to assist with education or to address unforeseen issues of inconsistencies, lack of clarity, or unforeseen complexities when implementing the new standard. The experience with the previous revenue recognition TRG has made clear that sometimes it can be necessary for the ISB to consider amendments to address questions, and indeed we have addressed some necessary small amendments to IFRS 17 last week in our board meeting. Of course, we hope to keep the number of amendments as limited as possible, because otherwise implementation would be disrupted, but we stand ready to act if necessary. Next, there's a lot going on in the world of wider corporate reporting. There's increasing interest in trends like sustainability reporting, integrated reporting, and reporting for public policy interests. And many of our constituents are asking us, where do you stand in these discussions? Well, we think that any organization needs to remain focused on its core competencies. And for us, that is financial reporting for capital market actors, investors and creditors. And that is going to remain that way. So while we recognize the importance of these other forms of reporting, many of them fall outside of our competence. That said, we do acknowledge that there is a lot of broader financial information which is not adequately captured in the financial statements. Things as intangibles, technology, business model, economic environment, and increasingly sustainability issues such as climate change. And of course, the more forward-looking information which is important to investors, but which escapes the financial statements, which is more backward-looking. The natural place to consider these developments is within the management commentary section of the annual report. Back in 2010, we created non-mandatory guidance on management commentary, and the plan is now to update that guidance to reflect new developments in integrated and sustainability reporting, and particularly the growing interest in long-term value creation, an important strand of work for the board. And finally, I'd like to mention a consultation that we have kicked off today. This morning, we published a discussion paper on financial instruments with characteristics of equity. And this research project is looking at ways to help companies issuing financial instruments to determine whether those instruments are liabilities or that they are equity. And as you know, although there should be a clear distinction between what you owe and what you own, in practice the distinction is often very difficult to make. And this work will give much more guidance and solutions to that. All of these topics and much more will be discussed in the next 2 days, and I hope you will find your participation in this conference rewarding, and I wish you 2 very enjoyable days. I thank you for your attention, and I would now like to introduce our keynote speaker, Mr. Luka Mucic. Mr. Mucic has had a very long career in the company, German company SAP. SAP stands for Systeme, Anwendungen und Produkte, and it also works well in other languages, systems, applications and products. It's one of the biggest software companies in the world, has over 335 customers around the world. So, and I should also say SAP has always been a very warm supporter of IFRS. So we are very happy that Mr. Mucic, who undoubtedly has an extremely busy agenda, that he found time to be with us and to give us his story. Luca, I give the floor to you.